Throughout this course, we've talked about risk, asset allocation, diversification, index funds, fees, taxes, and many of the technical aspects of investing. But today we're going to discuss something far more important, you, because the greatest threat to most investment plans isn't inflation. It isn't interest rates, it isn't market crashes, and it isn't the economy. The greatest threat to most investment plans is the investor in the mirror. Now, before you take that personally, let me explain. This isn't about intelligence, it isn't about education, and it certainly isn't about willpower. It's about human nature. You see, our brains were designed to help us survive. They were not designed to help us invest. When we sense danger, we want to run. When we see excitement, we want to join the crowd. Those instincts may have helped our ancestors survive, but they can create problems when it comes to investing. Let's look at some of the most common behavioral traps. The first is performance chasing. This happens when investors buy investments simply because they've recently performed well. A stock goes up, a fund has a great year, a cryptocurrency doubles in value, and suddenly everyone wants in. Unfortunately, by the time something becomes popular, much of the gain may have already occurred. Investors often end up buying high, then becoming disappointed when performance slows. The second trap is panic selling. This one is especially dangerous. Markets decline, the news becomes frightening, headlines predict disaster, and investors begin to fear they'll lose everything. So they sell. The problem? Many investors sell after prices have already fallen significantly. Then they miss the recovery that often follows. History has shown that some of the best market days occur shortly after some of the worst market days. When investors exit during periods of fear, they often miss both. The third trap is overconfidence. Most people believe they are above average drivers, above average communicators, and surprisingly, above average investors. The problem is that confidence can sometimes lead investors to take unnecessary risks. They begin believing they can predict markets, identify the next winning stock, or consistently outperform professional investors. Occasionally they get lucky, and that luck can reinforce dangerous habits. The fourth trap is familiarity bias. People naturally prefer what they know. They invest in companies they work for, companies they buy products from, or investments they've heard about repeatedly. While familiarity feels comfortable, it doesn't automatically create diversification, and comfort isn't always the same thing as safety. Now here's the good news. You don't need to eliminate emotions. You simply need a system that protects you from acting on them. Think about the lessons we've already covered. Automatic investing, asset allocation, diversification, rebalancing. These aren't just investing strategies, they're behavioral safeguards. They're systems designed to help you make good decisions even when emotions are running high. Imagine it's 10 years from now. The market suddenly falls 30%. News outlets are predicting recession. Friends are talking about selling. Social media is filled with fear. What will you do? The answer shouldn't be decided in that moment. The answer should already exist inside your plan. That's why successful investors create rules before emotions arrive, not during them. One of my favorite investing principles is simple. Never make a major financial decision during a period of extreme fear or extreme excitement. Give yourself time, pause, review your plan, talk to a trusted advisor if necessary, and then make a decision. Remember, successful investing is rarely about making brilliant decisions. It's usually about avoiding costly mistakes. Now open your workbook and turn to the section titled My Behavioral Safeguards. Write down 3 rules that will help protect you from emotional decisions. For example, I will wait 30 days before making major portfolio changes. I will review my financial plan before reacting to market news. I will continue investing during market declines. Create rules that work for you, because one day those rules may save you from making a costly mistake. Before we finish, I want you to remember one simple principle. The best investors are not the ones who never feel fear. They're the ones who have a plan for what to do when fear arrives. And that's exactly what you're building, a plan. Complete your workbook exercise and join me in our final lesson where we'll bring everything together and create your personal investment action plan. I'll see you there.